Welcome, everybody, to the Ultimate Advisors Resource Podcast. Today, we've got a really exciting topic. We're going to talk about what we call the Premier Bonus Plan. I've got our expert sales development rep, Alex Gonzalez, here. He's going to help us walk through some questions, what we need to think about when thinking about the Premier Bonus Plan, why it matters. We're going to go over how it works. I particularly like this strategy because it's just a unique take on the typical executive bonus plan. And we're going to share in the download our presentation that we use, which I think really highlights the benefits and compares this to other ways that, your client might be able to save and so forth. But Alex, thanks for joining us.
Thank you for having me.
So I guess let's get going. Let's start from the top.
Excellent. Well, why exactly is Premier Bonus Plan? What exactly is a Premier Bonus Plan, and what makes it different from a traditional bonus or a deferred compensation arrangement?
That's a really good question. And so the Premier Bonus Plan is effectively structured exactly like an executive bonus plan. So in executive bonuses, you have a couple of different flavors. Number one, you could do what they call the double bonus. And that used to be like the way to do it. And the double bonus is where, if you're putting $100,000 into the policy, you bonus the $100,000 into the policy. Now you, Alex, as the employee, you owe, let's just say, $30,000 in taxes on the $100,000. So we would bonus the $100,000 into the policy, and then we would bonus you another $30,000 to pay for the taxes. Well, that gets a little complicated and expensive for the employer because it's like, okay, I put in $100,000, now I'm giving you another $30,000 to pay for taxes. It creates a lot of problems. So you have the double bonus. You have just where the employee pays it out of pocket. Because again, an executive bonus, even if you're doing it for the business owner, somebody has to pick up the tax for that bonus. Mm-hmm. Again, on the $100,000 example, I pay the $100,000 into a policy as the business. Okay, the person who owns that policy has to pay the taxes on that premium because it's basically constructive receipt, right? They've got the money in the policy. They can do whatever they want with the policy. They can walk away from it. So that's actually taxable income to that person. Mm-hmm. Now, how that differs from deferred compensation, the employee has not received that compensation. They've actually deferred it. Mm-hmm. So that's the big difference between the two is in an executive bonus scenario, the executive has actually received that compensation as income in that year that the money's put in the policy. Whereas a deferred comp arrangement, that's all controlled on the employer side. And really, you would do a deferred comp arrangement more as a golden handcuff than you would as an executive bonus. An executive bonus plan I'm mainly doing for myself as the business owner. Mm-hmm. And that's the chief difference. Now, the Premier Bonus Plan is unique. It's our twist on the executive bonus plan. And what it is the company puts the money in, and then rather than the employee or the business owner coming out of pocket for the $30,000 in tax that I mentioned earlier, they actually take a loan from the policy to pay for the tax. And I'm going to get a little bit more into why you would do that over paying it out of pocket in the how it works section of this. But that's the chief difference, and that's our twist or our modification to the executive bonus plan. Does that make sense?
Yeah, absolutely. And, when it comes to this bonus plan, who is this strategy typically designed for? Is it mainly for business owners themselves, key employees, or both?
That's a really good question as well. And executive bonus, a lot of people talk about it as like an employee retention tool. And in theory, it could be used for that, but I'd say 99% of the time, it's the business owner that wants to save more, and they're doing this type of plan for themselves. Very rarely are they doing it for an employee. And in fact, personally, if I'm going to do a plan like this for my employee, it's going to be deferred compensation. I'm going to control the money. As soon as I make that premium payment to you, and I will make a caveat, there's a big caveat, unless I do like a restrictive endorsement or something like that, which is not the purpose of this conversation. But if I'm trying to keep you around, Alex, let's say you're a valued employee, I'm doing deferred compensation all day long. I'm doing a deferred comp plan, golden handcuff plan. I'm owning the policy as the business. I'm keeping control over it. I'm not just giving it to you and hoping you stay. So I'd say 99.9% of the time when we do a premier bonus plan, it's for the business owner that is, they were doing like a SEP IRA and now they have some employees. So now they don't know where they're going to put the money. In a SEP IRA, for those who don't know, many advisors probably already know this, but a SEP IRA is like it's actually called a simplified employer or employee pension. And it just allows for large contributions, but you have to do the same thing for all the employees. So if I'm a single business owner and I'm putting big contributions into my SEP plan, all of a sudden I hire you. Okay, now I've got to do the same for you. I know I'm not sure I want to put 25% of your compensation away for you in an IRA. I was doing that for myself. Now I got to do it for you. What am I going to do? That's where a premier bonus plan can fit really nicely. I see it fitting in any business owner situation where they're looking for a qualified plan. Maybe they're adverse to the expenses around a qualified plan. Like, for example, if I want to do a qualified plan and I've got employees, like a 401k plan is what I'm referring to, I might have to do a safe harbor match. Like we actually do a safe harbor match here. So in order for me as a highly compensated, as somebody who owns a firm, I have to do a match on behalf of my other employees. So maybe I don't want to go through that expense. So then I look at a premier bonus plan. That's really the target for it, is somebody looking at a qualified plan. They're like, I don't know if I want to go through the expense or a hassle of a qualified plan. I'd say they want to put away at least $10,000 a year up to infinite, right? We can put as much as we want, but generally you'll see the target between like 10 and 50,000 of contribution. That's really where I see this fitting. And like I said, we sort of talk about this as a way to reward key employees, but 95% of the time, this is for the actual business owner.
Yeah.
That makes sense?
That makes sense. And now that you bring up that point about the cash value, how is that cash value in the life insurance used in a premier bonus plan?
It's a really good question, and we'll put up on the screen the ledger of this. But how this works is really, I'm going to go straight to the ledger page. I'll just point at it for your benefit, and we'll share this on the screen. But in this example, what we're doing is a $50,000 premium for 10 years on a 45-year-old. So in the first year from my business, and let's say I'm doing this, I'm putting in the $50,000. Now, if I did that right now, I'm not going to owe taxes on the $50,000 till April of next year, right? Because that's when you pay your taxes. So April comes along, I'm going to take a loan from my policy for $15,000 to pay for the taxes on the $50,000. Now,
wow.
The benefit of doing this is it sort of cash flowed like it was a deduction, right? Because I'm not coming out of pocket for the $15,000 in taxes that I owe. I'm taking it from the insurance company's pocket. Now, the astute listeners out there, and you're probably already thinking this, is, okay, I put the $50,000 in, I took out $15,000. Why didn't I just put in $35,000? Like, why go through these extra steps? And that's the beauty of the indexed policy that we're using. This is the policy loan feature. So I'm going to use $1 as the example, Alex, because I think that makes it a lot easier to understand. But if I borrow $1 out of my policy, the insurance company is going to charge me 5 cents for the year, right? So 5 cents is the loan, 5% is the loan rate. Mm-hmm. So I'm going to take the dollar and pay the government. Okay, but that dollar is still going to stay in my index, and in this case, earn between 0 and let's just say 11% on the S&P 500. So if the S&P does, let's say 7%, I earned 7 cents on the dollar, but I was charged 5 cents, but I used that money to pay my taxes, so I netted 2 cents off the money that I sent to the government. So in a sense, I'm leveraging the taxes that I was going to pay anyways by putting the full 50,000 in versus putting the net of the 35,000 in.
Wow, that's incredible.
Yeah. So it's basically math, but the benefit of that is rather than putting the net in on every dollar that I borrow out of there to pay the taxes, I've got some sort of spread. Now, obviously, that spread cuts both ways.
Yeah.
If I earn 0 in any year, my loan balance is going to grow more. Like the loan balance will grow by 5 cents per dollar. But in most years, you're going to outpace the loan rate. And in fact, I get a year where I hit the cap. Okay, that's 11 cents, and I was only charged 5 cents. I netted 6 cents off money that I sent to the government. Now, if you put that to $100,000, on $1.06, that doesn't sound like much, but on $100,000,
on bigger numbers, it sounds a lot better.
On $100,000, that's 11,000 that I earned, 5,000 that I paid. I netted $6,000. That all of a sudden becomes substantial over a long period of time, and can actually deliver more income than you would have if you would have put the net in.
Wow. That's pretty cool.
Yeah, so in this example, and I'm going to guess because I don't have the actual numbers here, we could maybe provide the extra numbers. If somebody wants to email me, I will provide the actual numbers, but I'm going to guess right now. So instead of putting 50,000, let's say I put only 35,000 into this policy. The income at 65 will probably be somewhere around, let's say, 70,000. In this example, by doing the full 50,000 and then doing the 15,000 reimbursement, the income's all the way at 86,000. So you're talking a $15,000 increase in the amount that you can take out. It's going to be substantial. About, let's say, 20% more, basically.
Yeah, that definitely is substantial.
It really can be. So the way that we show this is just simply the client puts the 50,000 in year one, and that, if you're a business owner, should be paid from the business. That could be a deduction to the business, but I would count it as owner draws because I've had that question. It's going to be counted as owner draws if you're an S corp or a partnership or some sort of pass-through entity. But the bottom line of this is when taxes are due, I'm just borrowing that from the policy to pay for the taxes. And that's really the exciting thing about this is it looks and feels like a deduction, but on the back end, I'm getting tax-free income instead of taxable as compared to the qualified plan.
That's beautiful. And who wants to pay all those taxes
out
of pocket?
Exactly. So going back to our presentation here, and again, we'll put this in the download in the description. We're comparing this directly to a qualified plan. And so I'm looking at, if you downloaded it, page 7 on here. And what we're doing is we're saying you put 50,000 into the life insurance for the Premier Bonus Plan. Well, if I want to put 50,000 into a qualified plan and I have employees, I'm going to have to allocate some of that to my employees. So you're going to get 90% of that back in your pocket. And that's being pretty generous. So 45,000 goes into the business owner's 401k account. We're assuming an admin cost because you have TPA fees within a qualified plan. So that's about $1,500. And what I'm showing here is what the after-tax income from the qualified plan is. Now, if I use the same tax rate today as I have in the future, the amount of money I can take out of the qualified plan compared to the Premier Bonus Plan is $36,700 versus $86,000.
Wow. What a difference.
Yeah, it's almost 3 times. I mean, it's a big difference, especially when you're comparing it straight up to a qualified plan. And then what we put in here is this bar graph page. And what I find interesting about this, I don't know if you can guess it, but if the qualified plan was going to match the life insurance, what do you think it would have to earn?
I would say 5%.
The qualified plan is going to have to earn about 9.7% to match the life insurance. So if you compare the after-tax income, that's what your qualified plan has to earn to match this life insurance plan. And that's still assuming that you only earn 6.3 in the life insurance.
Yeah.
So that's the real power of these plans, is the fact that, number one, we're leveraging the taxes. Number two, it grows tax deferred. And then when we take it out, it's tax free.
That's beautiful.
Yeah.
Just that alone would be a huge selling point for any business owner.
Right. I think that's the big benefit, is the fact that for the business owner, at least, you're avoiding all of the compliance costs with the 401k. Like if you're comparing this to a qualified plan, the Premier Bonus Plan has no compliance cost. So in other words, you're not paying for TPAs. You're not having to make contributions on your employees' behalf. I mean, it's just pretty straightforward. You're buying a policy, you're paying for it through the business. You can put as much as you'd like into it. There's no contribution restrictions or anything along those lines. So it's pretty straightforward.
So how do those contributions work? Are they flexible, and how is a bonus treated on the tax standpoint?
Good question. So with life insurance, so this is a feature of life insurance, not necessarily the Premier Bonus Plan. But with index policies, index universal life, the premiums are flexible. So what that means is I can put whatever I want into this as long as there's enough cash to cover the expenses for the insurance. So ideally, now, based on the death benefit, there's going to be a maximum premium. So in this example, it's $50,000. If I put in $50,000 in the first year, and then second year I only put in $25,000, well, that's fine. You're just going to have less cash value. But in year 3, I could actually make up for that $25,000 deficit and put in $75,000 if I wanted to.
So kind of make up for the amount that you didn't put in before.
Exactly. Now, you cannot do that in a qualified plan. You can't make up for contributions that you missed the year prior. Now, those loans to pay for the taxes, that is a non-taxable event. So if I borrow the $15,000 out, that's not taxable.
Because it's a loan.
Exactly.
Yeah.
Now, furthermore, when I start taking income off of this in the future, again, it's not taxable. The $86,000 in this proposal that we have, that again you can download in the description, that is not taxable as well.
Wow, that's incredible, actually.
It's pretty powerful. So, in our presentation, actually, and I'll show this page to you, and we'll pull it up on the screen as well, but in our presentation on page number, sorry, I'm flipping to it, page number 4, what we're showing is the history of the highest tax brackets. And what's interesting about this, right now it's about 37% is the top tax bracket. Well, and I usually point this out to agents, business owners, whomever we're presenting this to. Would you guess that it's been as high as 95% in the past?
No, I would not have.
Now, everybody will have this quip, there's a lot of tax loopholes back then. And I'm like, yeah, sure, that's fair. But given everything that's going on, I don't know if it's 40 trillion now, 30 trillion, whatever the country's in debt now, where do you think taxes are going to be in the future?
Yeah. I mean, now you can pay taxes by helping the government do it through Venmo. So it goes to show how bad it is. So
yeah, send us some Venmo payments, help pay down the debt. So I think the advantage of using insurance is pretty strong because you're, number one, avoiding the unknown of the future taxes, right? So taxes could be a lot higher in the future. They could be lower, but which side are you willing to bet on?
Yeah, it's better to prepare for it to be at the worst than to just assume it's always going to be better in the future.
And again, with everything, I've said this a million times, I'm not saying qualified plans are bad. In fact, I think qualified plans are good. What I'm saying is don't put all your eggs in one basket. You could do a qualified plan. You could have qualified money. You could have money in an IRA. In fact, I have money in an IRA and insurance and other vehicles. But consider the fact that we don't know where taxes are going to be, and you might want to hedge your bets, is the point.
Yeah. Well, when it comes to that, how easy or complex is it to implement this compared to other executive benefit programs?
So when you talk about benefits for the business owner, this has got to be one of the easiest tax advantage ways to save money. And what I mean by that is everything else that you do as far as investing, whether it's investing in real estate, investing in the stock market, buying CDs, buying bonds, whatever it is, doesn't really matter. All of those things, unless they're in qualified assets, the only exception being annuities, is going to be taxable as you sell, as you recognize gains, as you do certain things. This is one of the few things that you can easily set up, besides annuities, because annuities grow tax deferred, that has significant tax advantages and doesn't require any admin, doesn't require any paperwork, any filings. It's just very straightforward and simple and easy to implement. Now, the hard part is if they can medically qualify for it. They have to go through underwriting.
Yeah.
I mean, that's really the only hard part about it.
Isn't that always with life insurance?
Exactly. I mean, and I will caveat, this is a great tool that you can use if you can qualify for it. And frankly, that's a great way to maybe get a client to move forward with this type of strategy. It's like, I don't even know if this is going to work for you, but we've got to see if you can qualify.
Yeah.
And if you can qualify, then we can implement something like this if you're healthy enough. There's obviously other solutions if you aren't, but if you need insurance, which I would argue almost every business owner probably does, especially if they have a family, and you want to save in a tax-deferred manner and have tax-free income in the future, this could be a perfect tool for you.
Should be plan A if you can qualify.
If you can qualify, you need the insurance, it makes a lot of sense.
Well, can Premier bonus plans be layered with other tax strategies or benefit plans?
Yes. That's the simple answer. Yeah. And in fact, I think it makes a lot of sense because, look, if you're going to do a qualified plan, do the qualified plan because you want to benefit your employees and yourself. If you want to just benefit yourself, do a Premier bonus plan. And that's the way that I would look at it. But I think it makes sense to do all of the above and not just pick one strategy. Again, the diversification. Makes sense.
Yeah. It's the most important thing to do. Like he said, don't put all your eggs in one basket.
I 100% agree. 100% agree.
Well, let me ask you, Jordan, where have you seen this strategy make the biggest impact, either for business owners or individuals? What success stories do you have?
So I would say for a lot of solopreneurs, and what I mean by that is people who, they have a business. They might have one or two employees, but they're kind of the main thing. They have an assistant or whatever. This seems to be a very attractive strategy for them because they don't want to go through the compliance hassle of setting up like a solo 401k or dealing with a qualified plan. This seems to be a very attractive solution for them. And I find when you compare a qualified plan or a 401k to doing this, people are more likely to implement it. So I would say definitely, your doctors, your lawyers, your real estate agents. We did one of these for like a nurse practitioner who was on 1099 and didn't have a qualified plan. This was like an easy solution for her. Mm-hmm. So people like that, I think, are ideal people for it. the larger a business gets, the more tax planning you can do, and you might implement a split dollar, which we'll do another talk on split dollar another time. But really, I find this, and I don't know, I don't really have a good reason why it's so attractive to those people, but it's a great alternative for those solopreneurs, it seems like.
Absolutely. And it seems like it also helps the business owner keep those important employees to actually stay with them.
Yeah.
And vice versa. The business owner is also not going to go too much out of their way or too much out of pocket. It's a win-win situation on both ends.
Yeah. And, this could be a good solution for retaining a key employee. Like I said, I find that a lot of these end up being the business owner doing it for themselves or maybe for their kids or whatever. But I think we should maybe put more of an emphasis on looking at your key employees and doing things like this for the key employees. Definitely.
Yeah. Well, I mean, you're thinking as a business owner, that's how you should be thinking.
You're right.
But also as an employee, I see it as a win-win on both sides.
Totally.
So
yeah.
It's a great plan.
So what I would say to everybody out there listening is think about any of your clients who are already doing like a SEP IRA. They may be considering doing a 401k. They're asking you about deductions, like, hey, what should I do to get deductions? And I would show them a traditional qualified plan, which we can help you show, as well as the Premier Bonus Plan. And just give them the facts and tell them the benefits of each one and then make a recommendation. That's what they want. They want to hear the options, and then they want you to tell them what you think they should do. And I think it's pretty straightforward. It's as easy as that. If anybody has any questions about this strategy, you can reach out to us. We'd be happy to run a proposal. I don't know if you have anything else to add, Alex? I think this is a very interesting strategy that we've had a lot of success with.
Yeah, I mean, from the way that you put it just now, it almost sells itself. Provide the options, and they just end up choosing. So
Exactly. And if you use our presentation, I think it makes it a lot simpler and easier to present this. So definitely, we'll have our contact information in the description. Reach out if you'd like a sample presentation, and we'd be happy to answer any questions.
Awesome. Thank you, guys.
Bye, everybody. Thanks.